Welcome to the daily stock review of Powerfleet Inc. Goal of this channel is to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months. If that sounds good, subscribe to come along. Who am I? I'm Jack. I'm an individual investor on the journey. I'm just 2,500 hours in over the last 7 years. I'm sharing the lessons along the way. This is my investing process. Today I'll go over how I came across this stock and perform the 5-minute check to see if it's worth looking into further. These are the guys I learn off. They did pretty well for themselves, and by following the breadcrumbs they've left behind, should be able to follow in their footsteps. If you like the free investing resources I wish I had when I first started, including how to value stocks, checklists, etc., check those out with the link in the description. Otherwise, let's get into it. Powerfleet Inc. is a US-based company, and you can see over the last 5 years, you wouldn't really say it's decreased, but it's pretty much gone sideways over that time. 37% decrease in stock price, and over the last 12 months, technically it's gone up 13% from its little low point last year. So we can see that it doesn't have a PE ratio, which means it's going to have an earnings, net income is probably a loss, which is why it's not showing up here. But even with this current price, the marketplace believes the business is worth $590 million. So how did I come across this business? I'm doing a screen at the moment looking at small cap stocks, anything below $2 billion. Now moved from the industrial sector over into tech and having a look through those. What I am looking for as well is high revenue growth. So say if they've had more sales growth in the last 3 years. So let's go and perform this 5-minute check. So all I've done is typed in annual report Powerfleet. Come and grab their annual report, which is the 10K. I like the 10K for the US-based companies instead of reading alternative types, just because it's in a standardized format. There's no fluff in it. Alright, so now I want to find the financial statements, because by reading through the financials, you can see what's already occurring within the business without having to read through the entire report, only then to find out this is a pretty mediocre business and it's not worth my time to have a look at. Alright. Gross. Alright, so we're looking at the income statement, and it's also known as a statement of operations. I can see here the revenue. We've got, it's a couple of bit weird columns here, but it's got year ended December 31, 2023, and then 3 months ended March 31, 2024. So it's only got, for whatever reason, at the moment, we don't know, because we haven't looked into it, only a 3 months worth of 2024. So looking at this column here isn't really going to help us, because it's not proportionate to the rest of the years. We'd then have to, there's might be some seasonality in the business and it might not be representative. Alright, so what we can see though is from 2023, if we skip 2024, we go to 2025 and then 26, you can see that revenue has gone from 133 million to 362 to 443. And where's that come from? Well, products has increased. Not a crazy amount, definitely a double, or almost a double in that time frame. But the services part of the business has grown very quickly. So that's 80, double would be 160, double that again would be 360. So the business has 4x'd its services revenue in that time. So that's a really good indicator that it's mastered its customer, especially in that respect. All right. Let's have a look at what the cost of the products are and the cost of the revenues, so we can have a look at what the gross margin is. So we can see that 59 million is our cost for 83 million out. So we've got about 25 million there from that. So that's pretty reasonable. It's kind of like a little bit less than 1/3 for products for the gross margin. What about our cost for services? Cost for the services is only 138 compared to 360. So we've got it pretty much the other way. We've almost got a $3 for every sale, and we only have to spend $1 on the services. We get to keep $2. So that's really good. So we can see that the margins in the business are increasing as the high margin services component increases as well. All right. Well, let's have a look around and see what's going on. All right. So we've got selling, general, and admin costs has increased quite a lot from 71 up to 208. We got a loss from operations every year except for the most recent year. So it looks like they have just held selling, general, and admin fairly constant for the most recent year. So they must have been happy with their growth and starting to happy with the expansion they're having in revenue. And now they've slowed that tap down. Now, what else can we see? Interest expense. So they got either some short or long-term debt that they need to pay off, 27 million worth, and now they're running at a loss for the most recent year. So we've got a net loss of 20 million. All right. So even with that loss, is this business interesting to look at? Yes. The revenue growth and the high margin part of the business is definitely interesting. And it shows that the business is starting to master its customer. From that point, we really want to be having a look at if the business has a strong moat around it, which I think it does. If it's got this much growth in the services part of the business and the margins of it are pretty consistent there, that's a pretty good sign. Margin is usually if you can price your products higher than what would be if it was a commodity and you had lots of other competitors. That's usually a pretty good indicator that it has a moat around its products and services. And that's what we want to see for a good long-term business. All right. Now this net loss, it's a little bit annoying. And it does shake away a lot of other investors. So say this business is making, how much was it this year? 443 million. It's made a loss, so then the price to earnings ratio can't calculate. But looking at revenue wise, it's making 443 million. It's got a market cap of 591. So say for instance, if it was able to get 5% of that earnings to hit, that would be about a 20, around a PE ratio of 20, for instance. Now, with the growth that the business is seeing, I think it's probably a little bit undervalued. Let's just say that. There's definitely, you can see other investors over this time have kind of had difficulty trying to work out where the value of the business is, what they're willing to pay for it, based on the high revenue growth, but also the fact that the business hasn't turned that revenue growth into profits yet. And so let's continue our analysis. Now we can have a look at the balance sheet. Just want to make sure that debt's not crazy. So what do we got? It's in thousands. Yep. So 910 million. Ooh, nice. And we've got total liabilities of 463. All right. So let's have a quick glance at this. So this business is being valued in the marketplace as 591 million. Now, if this business, worst case, went bankrupt and it had all its assets sold off to pay all its previous and current debts, so we'd just take 910 minus 463, we're still left with around, $450 million against that value. So it's pretty close. That valuation is fairly close to that liquidation kind of figure. And if we do a net, the net would pretty much be grabbing the total current assets minus the total liabilities. You can see that they definitely don't have enough on tap at the moment just to pay off all the current liabilities and all the non-current. So that's interesting. Just to take note, kind of where different valuation methods kind of sit. All right, let's have a look at the cash flow statement. So we've got our net losses come out. We won't look at this center column here, but we'll just take note of how it comes out. We want to see net cash provided by operating activities. Ooh, positive 30 million. Nice. All right. Where does the business need to... First of all, let's just have a look through and see if there's any random big lumps that come through that might have thrown out this year compared to previous. No. Literally just looks like the fact that they had less of a loss this year compared to the previous year, which the majority of that came from controlling the selling, general and admin costs whilst keeping that steady while the revenue grew. So if the business can pull off having the costs stay roughly the same and revenue grow again in this next 12-month period, the business should be looking at a net income profit. And when that comes through, majority of these investors that have purchased will be absolutely cheering. And then it may be a catalyst for other investors jumping on the bandwagon and being able to value the business more easily. All right, what else do we have? So there's nothing else is really interesting there. Let's see what they have to invest their money on. So we've got capitalized software development costs and capital expenditures. So they've got it broken up here. Some of these, usually it'll say plant, property and equipment. For a business like this, it's probably using this value here for that. Plus it's got capitalized software development costs. So for me, when I'm trying to have a look at what's the actual cash flow of the business, anything that these guys need to spend on the maintenance, like there's a capital expenses that are just required to maintain the business versus the capital to maintain plus I want to expand and grow the business. So some ratio will be part of this in trying to take that away. But if we wanted to find out our free cash flow, the calculation for that is this net cash provided by operations. So we get our 30 mil, and then we subtract our capital expenditures, which is minus 21. We're left with around 9 million. So that's better than previous years. Previous years, there hasn't been any, or except for this one here, we've had positive free cash flow. However, for me, I'd be wanting to dig into this capitalized software development cost, because there's going to be a component of that which is maintenance and growth, and they're real costs to the business that they need to spend. Sometimes it is just funny money, and that's just moving cash from the, I guess, what happened above this net loss income on the income statement. So moving the labor costs, capitalizing it, and putting an allocation of it here. And that is in an effort to move those costs from one spot to another and then depreciate it over that time, so they don't take a big hit for it at that time. Whereas the cash flow statement, we kind of see what's going on. So that's one thing to look for. We'd want to go into the notes if we're looking into this business further and have a sticky beak at it. Now, do I think management is being rational? Well, that's only part of the sheet. Let's go and see what they're doing with this debt. So in the most current year, they're repaying the long-term debt, just a little bit of it. What else have they done? They've also got some short-term bank debt, so they got some short-term, paid off some of the long-term. What have they done here in the previous year? They got 90 million. Payment of preferred stock dividend and redemption of preferred stock. Okay. And then to be able to pay for that, they've done a private placement. So that's usually they've sold a big lump of stock. And then they've also got proceeds from long-term debt. So they took on 125 million of debt just to pay off this preferred stock dividend and redemption of preferred stock. So without going into it, you'd have to look back and see, is this an ongoing, is that something that's a layover from when the business IPO'd or had more private shareholders, and go from there. Now, that's pretty much all I wanted to have a look at. Where's business spending its money? For this year, it didn't spend it, which is interesting. What's going to be the theme moving forward? We want to be looking for how many more of these one-offs they've got laying in the wind that they need to pay for eventually. So is this business worth looking into further? Is Powerfleet an interesting business? I'd say yes, it's got an interesting catalyst coming up. Do I think it's going to be a 100x business? Not sure. I have to do the deep dive and have a look at how much of their market is, what their competitors are, and things like that. So Powerfleet at this stage is worth a look into the business, especially just on the valuation side of it. If we've got another annual report coming out, well, the most recent one came out 2 months ago. So it'd be a good read up to see how they're tracking over the next 4 quarters. And then is that going to be a point that we move into the business? If it looks like it's going to turn a profit, if it's going to turn a profit, what's it going to look like? What's a reasonable valuation? And does it look cheap? So there you go. I'd be looking into this one a little bit further. Now, what are you guys doing? If you guys already bought into Powerfleet, you guys got another take on it, let us know below what your, thesis or your ideas around purchasing it are, so that other investors can understand how to look into businesses when, especially for the long term. And if you like this, feel free to check out this next video because YouTube thinks you'll like it. Cheers.